Welcome back to part two with John Mattingly. Last time I was talking to John, we were talking about the institutions, the city techs, and how they are or aren't making money. Let's carry on from here. So, John, we were talking about how these techs aren't necessarily making these institutions any money. Where do you think it's all going then? Automation? Do you not think it's the right way forward? Because, like you said, there's a lot of investment going into this, but we're not seeing the returns.
Yeah, it's obviously, you know, it's very difficult to forecast the future. But if one looks at the kind of wider arc of what's been going on, it looks to me that it might well be a progress trap. You know, a progress trap is where you've done so much progress that actually you've just, you know, put yourself into a cul-de-sac, if not an ability to kind of fall off the edge, as it were. I'd recommend anybody to read Ronald Wright's Short History of Progress if they want to understand what I'm talking about with progress traps. And it's certainly from the outside, and having been on the inside, you think, well, hang on a second, if this is not producing the money, at what point do you actually just stop it and say, let's go somewhere else? There's also this thing in banks, is that there's this it's kind of a religion to do with tech and progress, that it's become a myth almost, that the more tech and the more progress you get. And of course there's a very much vested interests inside banks in particular to just keep this tickling along. And you know, they don't want to explain it in plain English to senior management, so they tend to bamboozle them, and management's kind of sitting there going, God, you know, I don't really understand this stuff, but I guess they know what they're talking about. I mean, you know, we've got this guy from Cambridge who's got a PhD in, you know, quantum physics, for God's sake.
Are they a load of sheep as well? Because you've got one city institution, so one bank, who they've got a team of quants. Everyone's got to do it, haven't they?
Yeah, absolutely. It's, as I said, I think in the first part of the interview, you can't go to your next banking conference and say my quants are no good. You just can't do that, right? And you can't go to your shareholders and say, actually, we've made a mistake here, we should throw all these guys out. So I can envisage a future whereby, you know, the guys at the top are not stupid, right? You know, they know that they've got to get these returns. So I can imagine a future whereby they start to somehow get discretionary trading back into the thing. You know, your average discretionary trader, I don't know, if you're half good at it, you're going to be turning in, what, 3-4% a month at least. You know, I mean, Charlie, you've put yours up online.
Yep.
You've done better than that.
Yeah.
You know, so there may be this thing where they start to look to guys like us who are like cottage workers, really, aren't we?
Yeah.
You know, they used to outsource weaving, now they're going to outsource FX trading or equities trading.
Yeah.
So that might happen.
Yeah.
It's certainly something that, you know, if you were sitting on top of a bank and you had that clearer view, you might look at. But yeah, I think the next thing that I hear these quants and stuff talking about is saying, you know, well, that didn't work, but now I'm going to start talking about artificial intelligence.
Yep.
You know, that stuff absolutely is going to work. You know, the machines will rise, but you've got to remember that these algorithms are self-referencing. You know, just a tiny trade makes an effect on the market. You've got everybody doing AI, you're going to get a flat market, or you're going to get everybody exiting and whacking great big volatility, which of course everybody will exit and say, I'm not interested in this.
Yeah.
Again, you've got a small universe. There's only, you know, 10 or so banks who can do this and a few big hedge funds. So at the end of the day, it's not entirely clear, but you can see that we're coming to an inflection point with it. At least somebody at the senior level has got to start to be thinking, is this right? You know, just look at the numbers. Is this absolutely right? Do I really want to spend another $25 million on tech next year, or $100 million, as I've seen some of them do?
Yeah. For
these kinds of returns?
And so the way you see it is that they could be going back to maybe a blend at least between some automation and discretionary trading as well, and taking that expertise where an individual can actually say, look, I think I can spot an opportunity here in the markets, which the system isn't going to spot.
Yeah, that's absolutely right. I mean, sitting here today, our ability to recognize patterns and our ability to act on that, provided we control our emotions, is far superior to a machine. If you can blend that with an algo that perhaps, as some of them do, is to say, well, okay, I can recognize the condition with an algo and then manage the trade after that. You know, I fully get that. I've done that. Others do that. So that's it's a way to go. I think if you're asking me, are we going to see trading floors of couple of hundred traders all sitting there with expensive Bloomberg terminals and the like? No, that's never going to happen again. What might happen is we might have a kind of outsourced Uber-like type situation whereby these guys are outsourcing to guys like you and I, and we provide superior returns, which then aggregate up into a superior return at the top.
Yeah. Okay, and so let's go back to automation. Automation on a lower level. So the independent trader.
Yeah.
People like us.
Yeah.
Access to the likes of MT4 programs, easy to program these systems now.
Yeah.
And there's a lot of people out there trying to automate their own strategies. What's your views on that and actual independent traders automating their strategies? Because lots of people are trying to do it, but there's this thing called market cycles, isn't there?
Yeah, there is, yeah. My experience in doing it for myself and for doing it for others has been that the algos don't work for very long. The lag between thinking about it and getting it done also hampers you. And at the end of the day, what you're doing is actually just programming in whatever trader's psychology is there. So I go back to, I think what I said in the earlier one is sitting over the shoulder of one of these guys is, if you see that happening, if you think that that's what the market conditions are and that's where the opportunity is, well then just trade it, because that opportunity is now. If you think that somehow that opportunity is going to be there in 6 weeks' time when your C++ trader or your MATLAB trader, MATLAB programmer dumps you with your strategies, chances are that's not going to be the case, or at least it's going to have shifted somewhat. So you're going to have to constantly adjust these things. That's fine if you're trading with somebody else's money and somebody's paying you a handsome salary to do this, and you've obfuscated it enough to bamboozle management such that they're going to keep paying you because they keep thinking there's going to be jam tomorrow. But for the average trader, for you, for the guy sitting at home, you don't have time to do that stuff. You don't have the capacity to do that stuff. You don't have the balance sheet to hide the losses. You can't warehouse your risk in the same way that a bank can do. You can't, even the hedge funds are finding you can't do that, hence the performance that you've got today, that we were looking at today. So it's very, my advice to a retail trader is don't bother doing it unless you're just doing some tiny little thing. I used to do this so that when it fired up in the morning, if there was something that was interesting, it would alert me. And then maybe if it was really interesting, put a trade on.
Yep.
And then I would manage that after that. I ended up giving up with that stuff because the trades that it tended to put on as the market conditions changed, literally over a couple of weeks, it would get me in the wrong trade, and then I'd be panicking around trying to manage the trade. Whereas thinking it through clearly, with a clear mind, with a good breakfast and a dog walk behind me, I could look at it and get it right and say, no, I'm not going to take that trade, or yes, I am. And
now, very much, your philosophy is similar to mine in that I'll do a top-down approach as far as the analysis is concerned, get the overall analysis done, and then I find the strategy is my excuse to take the trade based on the analysis.
Correct.
And that's how you see the market, or you trade yourself.
Absolutely right. I go all the way from even sometimes a yearly chart, all the way down monthly, weekly, daily, and then I'll go through every single time frame looking for the fractals or the harmonics, as they're called, to understand what's going on, such that when I'm sitting there in front of a 5-minute chart, I think you use the term looking for an excuse to get in, because I know, or at least have a clear sense of the probability of the market moving one way or another, or if it doesn't move in that direction, I know what to do about it.
Yep. Okay, John, we're out of time again. Top-down approach, that's the way to do it for the independent trader. Top-down approach, analysis, and then select the strategy. Have a suite of strategies like you do. You said you have about 8. And then you cherry pick them out based on the market conditions that you've analysed.
Absolutely correct.
Brilliant. John Mattingly, thanks ever so much for coming back onto Tip TV. See if we can get you back on again, because I still think there's more that we need to explore. Still got more notes on you here. So that's the end for now. My name's Charlie Burton. We'll be back after the break.